Hello and welcome to The Trade. Before we get to the charts, let's catch up with what's going on at a macro level. US Fed Reserve Chair Kevin Warsh saying that inflation risks have come down, but said he will stick firmly to the central bank's 2% inflation target, telling a European Central Bank panel in Portugal that if people thought the central bank was going to be comfortable with an inflation objective above 2%, they would be disappointed. This is data from the ISM showed US manufacturing activity slowed in June as businesses front-loaded orders the previous month to avoid shortages amid higher prices stemming from the conflict in the Middle East. And on the geopolitical front, Iran and the US have concluded a round of indirect talks with no indication of progress. Negotiators for the two countries reportedly spent 2 days in Doha discussing maritime traffic in the Strait of Hormuz. Well, US Treasury yields initially fell, then rose following Kevin Warsh's comments. Markets pricing in a 30% chance the Fed funds rate will be hiked by 25 basis points at the next meeting at the end of this month. 100% chance of a hike by October. The Aussie dollar, it has weakened further and it's currently at 68.9 US cents. Well, let's now turn to the charts with a focus on both the local market and what we're seeing on Wall Street. I caught up earlier with Jason McIntosh from Motion Trader.
Starting off with the ASX 200. Well, I think the ASX 200 really is at a critical point here. So far, it's been a shallow grinding pullback to the moving averages. It's taken about a couple of weeks to get to where we are now, so the selling pressure hasn't been strong. I describe this as so far as a relatively shallow pullback in comparison to the rally off the June low. So you see that little blue circle I've got on the right-hand side of the chart, that's the June low. And from there, we've got a strong rally. So strong rally off the June low, while the pullback, as I say, has been choppy. So that's often a sign that the path of least resistance is higher. But this is where the ASX 200 really needs to hold the line. I think a dip below the moving averages, as we're seeing today, it doesn't rule out an ongoing recovery, but the deeper the pullback becomes, the more likely prices remain range bound for longer. And the range I'm talking about, the range I'm referring to, it's that big blue box I've got on the chart. That's the 10-month trading range, which has really kept the ASX 200 contained since around October last year. I continue to favour an eventual upside break from the range, but for that to happen, prices really need to attract buying support and hold around the moving averages where they are now. Another chart I want to have a quick look at is the ASX financials, what the financials index is doing. And I think financials will play a key role in what happens to the ASX 200 here. So what we have, prices are currently retesting the moving averages. And by the way, I'm using the 50 and 100-day moving averages on all of the charts. So far, financials are doing a good job of holding onto their gains off the June low. They haven't attracted significant selling around the moving averages just as yet. The question now is whether they can flip to the good side of the moving averages, and by that I mean getting above the moving averages and then start to seeing those moving averages turn higher. If the ASX 200 is going to hold above its own moving averages, then I think financials really need to attract buying of this latest dip that we're currently seeing. And lastly, on the ASX, I want to have a quick look at the equal weight. I think that's always a good one to stay across. This is also at a critical point. So we've got that strong rally above the moving averages a couple of weeks ago, but that hasn't been holding. Prices have been giving back a good portion of those gains. The selling has come from a resistance zone around 2,150. Now that's that blue horizontal I've got on the chart. I think if we get further weakness here, it really disengages that building upward momentum that was coming off the recent lows. If prices don't stabilise quickly, I think then it likely extends the consolidation phase. So as I said, I think this is an important point for the market. It's where prices really need to hold, and it's where buying needs to emerge. So far, the recent pullback in the ASX 200, it looks corrective, but I think the risk is elevated. Trading ranges, as we've had, they're just often difficult periods, Andrew, and this one is no exception. I think the play here is maintain exposure to the market, but be aware of the risk. And also, this is where good exit strategies can help manage risk.
All right, so that's what we're seeing on the local market, which of course has underperformed and then some compared with global markets, particularly what we've seen on Wall Street, also some Asian markets. because of that AI trade, we're sort of lacking those larger tech stocks which have driven those other markets higher. Let's take a look at the S&P 500 and what you're seeing there in terms of trends.
Yeah, and you're right about the local underperformance. It's underperformed the TSX, the Toronto Stock Exchange, the European exchanges, Asian markets. It really has been down the lower end of the list. But moving on to the S&P 500, trading range seemed to be the theme of the moment, with the S&P 500 in its own range. But unlike the ASX 200's 10-month range, this is only a 4-week range. Prices are currently trading sideways along the moving averages, and you can see that blue box at the top right-hand corner. That's the range I'm referring to. There was a test of the 50-day moving average on Friday, followed by a bounce. We saw similar price action earlier in the month with a test of the average and then a bounce. So that's classic buying of the dip. And we often see this type of price action in bullish markets. Prices pull back to rising moving averages and then rally. So far, I've described what we have as a shallow pullback from the June all-time high. Prices are currently less than 2% from that high. So that's a modest pullback, not a warning sign. So I think the price action we're seeing in the S&P 500 is consistent with an ongoing uptrend. Nothing has changed from that perspective. I want to now have a look at an ETF. It's an ETF of the Magnificent Seven. So this includes Nvidia and Apple and Meta and the like, all those big AI-orientated stocks you referred to a moment ago. And I think this is the most concerning aspect of the US market at the moment, and that's big tech. There are well-known fears of an AI bubble that's been spoken about for months. So I'm not worried so much by the commentary. It's really the price action that matters to me. So while the S&P 500 has been range bound for the last month, the Mag 7, or this ETF, it's been deteriorating. It's been down by as much as 15% from its recent all-time high. And that's despite the latest rebound. It's still nearly 8% below its high. The ETF only goes back to late 2023. That's when it listed. But in that time, the S&P 500 hasn't been able to sustain a rally when this ETF has been pulling back. And like you look at I've got 3 blue markings on the top of the chart. Early 2025, early 2026, when we saw weakness in the Mag 7, that was an early warning for weakness in the S&P 500. That's not to say a sell-off is about to happen, but I think this is a condition to at least be aware of. And I think there's an elevated risk while the Mag 7 continues to weaken. One chart I want to finish with, which I think finishes up on a positive note. It's a percentage of Russell 3000 stocks above their 100-day moving average. So the Russell 3000 is a broad measure of US stocks. Russell 2000 is the small caps. Don't confuse it with that. Russell 3000 covers most of the US market. So as I say, this is showing the percentage of stocks above their 100-day moving average. And this continues to increase. It hit its highest level since January on Wednesday. It currently sits around 66%. So 66% of Russell 3000 stocks are currently above their 100-day moving averages. The trend here is up. The indicator has a series of rising lows, rising highs. So the number of stocks above their 100-day MAs is trending higher. As it stands, the overall market is up. So we're seeing that trend in the S&P 500. We're seeing it in the Nasdaq and in a range of sectors. But the divergence in the Mag 7, that's the cause for caution. My approach here, it's staying long. As I say, the trend is up. I don't want to sell unless it breaks down. I'd rather try and stay on a broader trend and give it room to move. One last statistic to finish with, Andrew. I think this is interesting. The S&P 500 has never made its high for the year in June, not once. So that's going back to 1950. That's not to say this year can't be the first, but I think the odds favour a new high coming in the coming months. So as I say, stay long, don't be complacent. We always need to manage risk, and that's where that's where trailing stops and exit strategy really comes to the fore.
Never made a high in June. Well, maybe because everyone's on holidays stateside at this time of the year, Jason.
Yeah, it's highs have happened in July. They haven't happened in May, but yeah, that's the stat that hasn't made a high for the year in June. So most of the highs for the year tend to have been in December and January. Yeah, June's the lonely one with a zero beside it.
And that is the trade.